The price of gold is smashing all-time records, recently blasting past $3,700 an ounce. So why are the companies that actually dig it out of the ground still trading for pennies on the dollar? It's the biggest mystery in the market right now, and one that has frustrated a lot of investors who've watched the metal soar while the stocks that mine it have lagged behind. But that frustration is about to turn into a massive opportunity. In this video, we're breaking down 5 specific company-level reasons that show this bizarre disconnect is about to end. We're not just talking about the gold price going up. We're going deep into the balance sheets, the cost structures, and the operational reports to uncover the hidden catalysts that the mainstream market is completely missing. This isn't a story about what could happen. It's about what is already happening inside these companies right now, setting the stage for what could be a historic boom for gold stocks. First, let's set the stage. Gold isn't just having a good year. It's living in a completely new reality. It's being driven by record-breaking purchases from central banks looking to get away from the US dollar, sticky inflation, and general geopolitical chaos. Because of this, gold has set a new, much higher price floor. Forecasts from major banks like UBS are now calling for gold to hit $3,800 an ounce by the end of 2025 and potentially push toward $4,000 in 2026. And yet, for the better part of a year, the stocks of the companies mining this gold have been bafflingly cheap. Investors who owned them felt like they were holding a winning lottery ticket, but the cashier just refused to pay out. But the tide is finally turning. While the miners have lagged, they've recently started to make a big move, with some indexes like the NYSE Arca Gold Miners Index showing returns of over 50% year-to-date in 2025. But here's the critical part. They are still nowhere near catching up. That gap between the price of the metal and the value of the miners is one of the greatest opportunities in the market today. And here are the 5 company-specific reasons why that gap is about to slam shut. Reason 1. Extreme undervaluation and the historical disconnect. The first and most straightforward reason is that gold miners are, by almost every historical metric, dirt cheap. I'm not just talking about low stock prices. I'm talking about their value compared to the very thing they produce. Think about it like this. Imagine you own a factory that makes a product, and the price of that product just doubled. Logically, your factory should be worth at least double, if not more. But in the gold space, the price of the product has soared to record highs. While the factories the mining stocks are still being valued like gold is back at $2,000 an ounce. This isn't just a feeling. It's right there in the data. Key valuation metrics like price to earnings are at a massive discount to the broader market, and more importantly, to their own history during past gold bull markets. For example, while the S&P 500 trades at a forward PE ratio of nearly 25, the components of the GDX Gold Miners ETF have recently traded at a PE closer to 20. That's a huge discount for companies with far better earnings growth. This isn't normal. Historically, mining stocks give you leverage to the gold price. A 10% move in gold should cause a 20%, 30%, or even bigger move in the miners. For the past couple of years, that relationship has been broken. We're starting to see it snap back into place. This undervaluation is a coiled spring, and the market has mispriced these assets on a historic scale. It creates massive potential for a catch-up rally as big money starts to notice the disconnect. Reason 2. Insane profit leverage. This brings us to the second and maybe the most powerful reason: operational leverage. It sounds complex, but it's brutally simple. A gold miner has mostly fixed costs. Costs a certain amount to run the trucks, pay the geologists, and operate the processing plant. That cost is called the all-in sustaining cost, or AIC. For many major producers today, that number is around $1,400 to $1,500 per ounce. Here's where the magic happens. Every single dollar that the gold price rises above that fixed cost flows almost straight to the company's pre-tax bottom line. It is pure, high-octane profit. Let's run the numbers. A few years ago, with gold at $2,000 and an AIC of $1,500, a miner made a $500 profit per ounce, a decent margin. But today, with gold trading around $3,750, that same miner is now making $2,250 per ounce. A revenue per ounce hasn't even doubled, but their profit per ounce has more than quadrupled. This isn't linear growth, it's exponential. This dynamic is creating a fire hose of cash flowing into these companies unlike anything the sector has ever seen. We're seeing profit margins expand at nearly double the rate of gold price increases. While margins used to be in the teens, many major miners are now reporting net margins in the 25% to 35% range. This isn't just a good business, it's one of the most profitable industries on the planet right now, and the market hasn't priced it in. If you're starting to see how powerful this leverage is, do me a quick favor and hit that like button. It's a small click for you, but it tells the YouTube algorithm that this is the kind of deep dive financial analysis that investors are actually looking for. Reason 3. The war on costs is being won now. You might be thinking, sure, the margins are great now, but what if costs go up? That's a fair question, and it's what separates this bull market from past ones. The miners of today are not the bloated, inefficient, debt-ridden companies of the 2011 peak. They have spent the last decade on a brutal but necessary diet. This is the third key reason: a structural shift to discipline and efficiency. After the last cycle collapsed, miners had to get lean or die. They brought in new tech, from an AI-driven exploration to automated hauling trucks that permanently lowered their costs. They've become ruthless about only developing projects that are high-grade and make economic sense. We can see this clearly in the numbers. Even with inflation hitting the global economy, the average AIC for the industry has stayed remarkably stable. While some costs have gone up, many top-tier operators have kept their AIC below $1,400 per ounce, showing incredible cost control. This means the insane profit leverage we just talked about isn't a temporary fluke. It's sticky. Because these companies have fundamentally re-engineered their businesses, they are now built to turn higher gold prices into sustainable, long-term cash flow. They are no longer just passively benefiting from the gold price. They are active, efficient operators ready to capitalize on it. This focus on cost discipline ensures that the current windfall isn't wasted, it's being turned into real, durable value for shareholders. Reason 4. Fortress balance sheets and capital discipline. That leads directly to our fourth reason. The miners have never been in stronger financial shape. The last gold mania that peaked around 2011, mining executives acted like drunken sailors on shore leave. They took on mountains of debt to buy mediocre projects at inflated prices, destroying a ton of shareholder value in the process. Investors have long memories, and that painful experience is a big reason why money has been slow to come back to this sector. But here's the irony. The companies today look nothing like their past selves. Over the past decade, they have used their cash flow, not for crazy expansion, but to systematically fix their balance sheets. Debt levels across the industry are at multi-decade lows. Many major producers now have net cash positions, meaning they have more cash in the bank than total debt. This is a complete night-and-day transformation. These fortress balance sheets are a game changer for two reasons. First, it makes them incredibly resilient. They aren't at the mercy of capital markets and can handle any short-term swings in the gold price without breaking a sweat. Second, and more importantly, it gives them immense flexibility. They can now fund exploration and growth projects with their own record-breaking cash flow without having to dilute shareholders by issuing new stock. Plus, they are in a position to return massive amounts of capital to shareholders through dividends and stock buybacks. This is already starting, and as those dividend yields grow, will attract a whole new class of generalist and income-focused investors who had previously ignored the sector, creating a powerful, steady bid for these stocks. Reason 5. The hidden growth engine of M&A. Finally, our fifth reason is the catalyst that could truly light a fire under the sector. A new wave of mergers and acquisitions, or M&A. One of the hardest things to do in the world is to find a large, high-grade gold deposit. They are incredibly rare. For major producers who are watching their existing mines get older, the fastest and most efficient way to grow is not to explore, but to acquire. It's often cheaper to buy ounces on the stock market than it is to find them in the ground. With perfect balance sheets and bank accounts overflowing with cash, the major miners are now in the perfect position to go shopping. The targets, the mid-tier and junior producers, which are even more undervalued than the seniors. This M&A cycle is already showing signs of heating up in 2025, with a noticeable increase in deal-making. This is where things could get explosive. The entire gold mining sector is tiny. Could fit the market cap of every publicly traded gold miner inside of a single mega-cap tech stock. It's because the sector is so small. When a wave of M&A begins, it doesn't take much money to send valuations soaring. When a major producer buys a smaller one, they almost always pay a big premium, typically 30% or more over the current stock price. This creates a ripple effect across the entire industry. It forces the market to reevaluate what every other similar company is worth, leading to a sector-wide re-rating. As the big sharks start to circle, every smaller fish in the pond suddenly looks a lot more valuable. This M&A dynamic acts as a powerful built-in catalyst that is largely independent of the day-to-day gold price. So let's tie it all together. You have a sector that is historically undervalued, just as its profit leverage is kicking into overdrive. These companies have fundamentally reformed their operations, embracing cost discipline and building fortress-like balance sheets. And now, they are on the cusp of an M&A cycle that will force the market to see their true worth. It's not just one of these factors at play. It's the powerful combination of all five happening at once that creates a truly rare, maybe even a once-in-a-generation investment thesis. The disconnect between the price of gold and the value of the companies that mine it has been a source of frustration. But it has created an entry point that savvy investors dream of. That window is now closing. The boom in gold miners isn't a question of if, but when. And all the evidence suggests it's just getting started. If you want to know which specific companies are best positioned to ride this powerful wave, make sure you subscribe and hit the notification bell. In our next videos, we'll be diving into the individual stocks that we believe have the most explosive potential in this environment. Thanks for watching.
Stack it up real high. Come here to be in the know. Come here, enjoy the show. 'Cause it's Warren's money time.